Uh,
All right, fantastic. So let's get rolling here. Hello, everybody. In case you don't know me, my name is Alex Brashears. I am the admin for the group Private Lending Lessons, which is hopefully how you found this particular event. But if you didn't, feel free to join the group. Today, we have another educational event, and this one's going to be related to insurance. And you might be thinking, oh, yeah, I have hazard insurance. My borrowers require me to have hazard insurance or have insurance. But what happens if the insurance that they think they got at closing lapses or changes, or the carrier no longer covers their area during the course of the loan? What happens to us as lenders if that insurance lapses and maybe they don't know, or maybe they intentionally cancel the policy? You don't know. Borrowers do some crazy things sometimes. So this is why I thought it'd be a great opportunity to bring in Laura and Kris and talk about what forced place insurance is, because a lot of newer lenders aren't necessarily familiar with this term or even what it is, much less how to go find a provider for it. So I thought I would bring them in to do a little bit of talk about what forced place insurance is, why it's important as a lender, and kind of what their next steps are as you continue to grow your private lending business, practice, firm, whatever you want to call yourself, and what that looks like going forward in the future to kind of help protect you as the lender. Another way to help protect you as a lender, another layer of insurance. So without further ado, I will have Laura Beaty. Is that how I say your last name?
Beaty.
Beaty. I was close. Laura
That's
Beaty.
right.
I figured it should be close. So Laura Beaty is going to be talking to us today about forced place insurance, and then her associate Kris also does the insurance component as well, and he can also answer some insurance questions that you all may have. You can feel free to either type messages in the chat, send me a private message if you don't want to openly have that discussion, or they'll have their contact information at the end of this presentation. You can always reach out to them directly. So without further ado, take it away.
And I'm actually, thank you all for having us. I'm going to let Kris start, and then we'll go from there.
all right, great. Well, thank you, Alex. Thanks for having us. Thanks for the invite, and thanks for allowing us to introduce forced placed insurance and some of the solutions that lenders do need and will need moving forward as they get into the lending practice. And it never fails. We always get phone calls for people searching for insurance policies, and what can we do? How can we help protect ourselves? How can we have a policy in place so that we don't have to go tracking down the borrower and or some carrier to place insurance on a property that we've lended on? So voila, that's forced placed insurance from a 10,000 foot view. So I'm Anderson Agency. My name's Kris Anderson. I live in Indianapolis, Indiana, and we're a family owned agency that's been around for 43 years. And our partner on the administration and the underwriting level is SUI, and that's Southeastern Underwriters, and that's Laura Beaty. So we have had a relationship with them for probably 15 plus years. I know they've been around since 1978, if I had to put a finger on it. Yeah, okay.
78 is correct.
So a whole lot longer than Laura and I have been around. So, but they are our administrating partners on this and offer a multitude of different solutions, as well as a tracking solution and a write your own solution with their own platform. So I will introduce Laura and let her talk. Actually, I just did. How about that? How about Laura? If you want to jump right in and take over from here.
Great. Thanks, Kris. Thanks, Alex, again for having us. I am a client manager for Southeastern Underwriters. I have been with them for 20 years and have been in the industry for 35. I worked for Progressive in their financial services group before coming over to Southeastern. So to tell you a little bit about us, we are an MGA, that's a managing general agency that has served traditional lenders since 1978. We're currently monitoring residential, commercial, and installment portfolios for about 600 lenders across the nation. The private lender sector is a newer sector to us, but a rapidly growing sector. And so we've really kind of jumped into this in the last 4 or 5 years. We have a web portal that is very easy to add and cancel individual properties as you need to. And then we, as Kris said, have partnered with the Anderson Agency for years on traditional bank programs, credit union programs, and now working through a lot of the private lender info. And this is very informal, so if you have a question, please stop me at any time. So as Kris and Alex alluded to, the big thing is, how do you handle your insurance today? We are finding those private lenders are monitoring their own internally through some kind of tracking system, tickler system, some way you are making sure that properties that you own or loan on have insurance. And we do know that that's a hassle. People pay late. You're not listed as the mortgagee, and chasing those things down is no fun. But when you don't have a lot of loans, you kind of have to figure out ways to do that. But what do you do when you can't verify coverage? Your borrower's not responding to you. They don't have it. They can't get it for either hazard or flood. Are you looking for local agents to try and find coverage, hoping you get it, and there's not a hurricane or tornado during that period of time? So that's where our product comes in. Lender-placed insurance protects both you, the lender, and your borrower. Now, protecting your borrower, it protects your borrower up to the coverage limit, and the coverage limit typically is the loan balance. It would not protect any contents or personal items. We're talking about the structure. We write it through a master policy with the lender as the named insured, and then there are individual certificates that fall beneath the master policy that name the individual property. So once you set up a master policy, it's there. And then if this afternoon you can't find coverage on someone and you need it, you can just zip out to our website and place it right then and there. And then if they provide proof of coverage tomorrow, you can just go out there and cancel. Our coverages do include residential, commercial, and builder's risk, and we can write for occupied or vacant properties. And we do hazard and flood, as I've said. And if there are properties where you own the property, we do have REO, real estate owned, and that comes with liability coverage. So in case something were to happen on that property, you would have some liability coverage. We do have regulated communications. Our practices all comply with the CFPB, which follows more the traditional lender side in terms of protecting consumers. So it's kind of an option that's out there. You all don't have to follow those rules because you're considered more commercial, but we have that available should you ever need it. So our web-based program, you monitor for your insurance however you do that. If the property becomes uninsured, you add it to our web portal. We do have letters available there that we can send if needed, or we can immediately issue a certificate and bill you the next billing cycle. We bill once a month on the first Tuesday. We would bill you then for that month of coverage after the property is added. So to establish a program, it's very simple. We have a one-page application that talks about your loan portfolio. Then we would need a listing of your current properties with the property address, the loan balance, and the replacement cost. Our underwriters need that to be able to underwrite the portfolio, because at any period of time, we could have to cover any one of those loans. So they like to take a look at all of that. And then once we have these two, we can quote both hazard and flood. Hazard and flood are two completely separate programs, separate master policies, separate rates. Obviously, not all your loans are in a flood zone, and you could have someone who has hazard insurance and not flood. So you would only need to write for one of those. As I've said, the master policy does cover all the loans in your portfolio, and you can add and cancel those individual properties as needed. So the certificates, as I've said, we have those 4 options out there. The certificates are issued for an annual term. However, we find that the private lenders like to pay monthly because you don't know how long you're going to need the coverage, and you don't want to fork out an entire 12-month premium. And most people don't need the coverage for a full 12 months. It's on average, 3-4 months. Our rates are based per $100 of coverage. And this is the important part. At any point in time, your borrower comes back with proof of good coverage, we would refund the unused portion. So if you wrote something effective March 1st, and today on April 18th, the borrower shows up with proof of coverage dated March 1st, and you had paid us already for the month of March, we would refund the whole thing to you. If they showed up with coverage today, effective today, April 18th, we would earn from March 1 to April 18th, and that would be it. And then, then if 2 months from now that same borrower has a problem again, you can go back and add them to the portal again. That's not a problem. People do that all the time. So then when you get bigger, SUI does have a product where we can track the insurance requirements for you. We can notify your borrowers that they need to provide current hazard and flood, and just kind of take that headache out of your shop. It does make the most economic sense to utilize this service when you're a little bigger. If you've only got 20 or 30 or 40 loans, it's not really a cost-effective proposition for you. But when you have 2 or 3 or 4 or 500, then that's a different discussion when the tracking is taking up, a lot more of your time than you want it to, and you want to be able to redeploy your people into tasks that are going to earn you money and not just chase insurance. So there's a fee for this service. And the key here is we would have to get an electronic file weekly, and we have file formats that we can give you so that you send us the file. We know what loans we're tracking. You upload insurance to a secure portal, and then we can figure out who has insurance and who doesn't. And we are again following all the regulatory practices of all the states. So we streamline any of that. Like for example, in Illinois, if you force place a borrower in Illinois, there's a special letter, document, notice of insurance that has to go out to the borrower with the first place certificate. And we're monitoring all that, and we know all that's taken care of. So how can we help? Here we are, a much younger me, and Kris Anderson. These are our contact information, our phone numbers. We are happy to have conversations with you about your individual situations, your individual portfolio. If you want to see the web portal, any of those kinds of things, we are more than happy to have those conversations. So that's it. Sweet and simple. Insurance in a nutshell.
I love it. Kris, I was hoping you would go through possibly some of the pricing and talking about how it's done per state. I know the presentation mentioned like per 100, but maybe running through an example of a property lender found out that there isn't necessarily insurance on this particular property, and just run through an example of what that pricing and what that process looks like if they already have a master policy in place.
Yeah, absolutely. Happy to do so. And before I do that too, I was going to interject, Laura, but I didn't want to, you were in a rhythm, so I didn't want to break it up. So you're welcome. 2 things that we typically see in this private lending space too, when you're going to need force-placed insurance, is if you're doing 6-month, 9-month, 12-month loans, and the project is running longer than what that loan term is, that's typically when we see an opportunity for the force placing, because those borrowers aren't going out and getting a new insurance policy or a renewed policy for an additional 1 month or 2 months or 3 months. They're just typically not messing with it a lot of times. So, and as a lender, you're typically always going to require a 12-month policy, sometimes a 6-month policy, but a lot of times a 12-month, and that borrower just doesn't want to pay for it for whatever reason, or it's just the time of doing it too. A lot of times they don't want to take the time of doing that. So we see that happening a lot. And then we also see some borrowers that are just canceling their policy in 2 to 3 months after the loan has closed. So that's something to keep an eye on too. So we do see that happen as well. But to give you an idea, so the way that this is rated is carriers will rate it based on the market. So anything in the inner United States, so consider it your Midwest, anything that's non-coastal will have a rate a lot different than a property in, let's say, Florida. So just as an example, we're seeing rates, and I'll keep the math simple here for myself, but if we have $1 rate per 100, then if it's $100,000 property, what you're going to see is $1,000 annual premium on that property, plus taxes and fees. So the way you get to that math is you take the $100,000, so the coverage amount of that property, and you divide that by 100, and then you multiply that times the rate. So if the rate is $1 per 100, that's how you come up with that $1,000. So roughly, it's a loose math there, but it's close to probably $1,100 or $1,200 once you add in the taxes and fees. And then if it is an REO policy and the liability is added in as well, then you're probably going to look closer to that $1,200.
And this is a good thing to know just from a lender's perspective, since I know we have a couple newer lenders on this particular call right now. If it's in your documents, it should be in your documents. Again, I'm not a lawyer, I don't play one on TV, but my personal opinion is it should be in your documents that you as the lender have the right to do forced place insurance, and that you're going to be recouping some of these costs that are going out the door for forced place insurance. So if you have a master policy already in place for the states you lend in, because I believe it's done by the state you lend in, correct, Kris?
Correct.
So if you already have a master policy in place that's got that rate that you already know, you've locked it in with your master policy, you can at least have some idea of what those outgoing costs could be as a lender. If for some reason this loan goes into default, the insurance lapses, it gives you a heads up like, hey, should something go wrong, maybe I'm going to have to set aside $1,100, like Kris's example, to say I'm going to have $1,100 stashed aside for emergency use for this particular property to do forced place insurance if I have to. And I know Laura mentioned you could do monthly, but worst case scenario, it sounds like it would be about $1,100 for a $100,000 property that would be quoted at $1 per 100 is the way it's quoted here. So just to give some of the lenders an idea of why they're talking about this math, is you're using that process backwards to kind of establish an expense number. Should something default on the loan related to insurance, you now know, oh, I need to step in, and maybe there's a fee for your time, as the lender, there's a fee, $250 fee to place this forced place insurance, because you have to go through the process of logging into the portal, putting the information in, how much coverage do you want? It's some of your time and expense, plus the actual expense of getting the policy, the taxes, the insurance and everything, getting the certificate, making sure you're covered. So having that sort of information written into your loan docs, it's going to be specifically in your promissory note, especially, really helps you as the lender, and also the borrower. Think about it, like it's very clearly outlined. If you let the insurance lapse, I have the ability to force place insurance through my master policy in this state, and I'm going to recoup the cost as a lender.
Right.
Right. And so Kris's example, on a breakdown, it's roughly $100 a month, and we actually calculate the rate by the day. So if you only use 15 days in a month, we only charge you, half of that. But that's a way to think about it is, okay, I got to have $100 a month. For every 100,000 of coverage, I need $100 a month to make sure I stay covered. And then should your borrower come prove insurance at a later date, you're going to get it all back if they've had coverage back to the start date.
Mm-hmm. And another point I want to make too is it doesn't cost anything to apply or have the master policy issued to you as the private lender. The only time you will pay for this program is when you actually force place insurance, and that's it. So we like to explain it as it's just a policy that sits on your shelf, and you take it off the shelf, dust it off, and force place insurance when you need it.
And if you happen to be a newer lender, because I had this conversation with Kris, if you happen to be a newer lender and maybe you don't have this big long loan tape of loan experience, so the underwriters can kind of measure what your portfolio looks like, you can always explain to them, this is what my business model is. I'm going to lend on these types of properties in this state for this length of time. And they can underwrite according to that business plan. So it doesn't necessarily you don't have to wait until you've had 50 or 100 loans under your belt before you get a master policy. They can underwrite it according to your business plan moving forward.
Yes.
Yeah, and if that changes in the middle of the year, then that's fine. If there's a policy, not a policy, if there's a property you need to force place on, and it's something that was outside of the box of what we issued the master policy on, then it's a simple email to Laura and myself, or just Laura or just myself, and we'll get the master policy adjusted to be able to cover it. So it's
Yeah.
it's a moving target.
And,
Yes.
and as Kris said, the coastal areas, especially at this time of year, as we approach the start of hurricane season, our underwriters are very sensitive on the coastal risk. And so those rates are significantly higher than $1. In Florida, we see those rates in the $3 to $3.50 per 100 range. The same thing, coastal Texas, coastal Mississippi, coastal North Carolina. But we hope you have a lot of properties in other places besides those to balance out those coastal risks.
Yeah, we will take them, but it's easier if there's others elsewhere, right, Laura?
Absolutely.
One thing to explain there too, Laura, and you could probably do a better job than me at this, but if you have a master policy issued to yourself as a private lender, and let's say your borrower is in Florida and they're trying to get something renewed, but they cannot because we're going into hurricane season, or the building codes have changed again, or a multitude of different reasons. Maybe all the carriers are on a moratorium because of the potential threat of a storm. If you have that forced place master policy, we can't tell you no. So
it has to be really bad. Like we did have one of the recent Cat 5s. It was one of the first times we've actually had a moratorium, 2 or 3 days before it hit. But that's like, we had Ian. I live on the coast of North Carolina. We had Ian in September, end of September, that hit here as a Category 1. We had no moratorium on that storm coming in. So, but if you wanted to try to get a master policy while there was something brewing in the Gulf or elsewhere, chances are we can't write those right at that point in time. So it's kind of one of those exercises where the whole process from you fill out the application till we get everything we need, we get the master policy issued, we can do some training for whoever in your shop needs that training. That whole process can easily be done in a 2 to 3 week period, just depending on how we hit the carrier, how long it takes them to get the quote, we get it to you, feedback it, it's signed, but it's not a 1 day process to set up. It's probably 2 to 3 weeks. And then, as Kris said, you have it on the shelf. If you need it, you can go to the portal and get it.
Mm-hmm.
And then the other thing I think you mentioned when we were talking, Kris, is those rates are locked in, at least to a certain degree. So if you're getting rates quoted now, and inflation tells us anything, nothing's really going to be getting cheaper in the future. So you're potentially locking in lower rates now than you would a year from now or 2 years from now for whatever those areas price per 100 might be. Is that a correct assessment?
There are reviews done of portfolios, and if things do change materially, we may re-underwrite.
Mm-hmm.
Or if there's a loss history that's not favorable, we will re-underwrite. But normally they, stay as they are. I think last year in my portfolio of hundreds of accounts, 300, I changed 2 rates, and they were both due to loss experience.
Mm-hmm.
So another good bonus for being proactive about this is you can potentially lock in rates before hurricane season hits in 2023. But the other thing I really enjoyed talking to Kris about is he actually can do the insurance component of it for the borrower. So he kind of understands what the perspective is from the borrower, but since they also do this forced place insurance part of it, they understand the requirements of the lender. So it was really great to have conversations with you, Kris, about like what's the something that I'm missing in this insurance requirement, or what's the downstream ramifications of having this requirement versus this lower requirement. Or because the other thing I noticed, the one rate that was quoted, but you covered builder's risk, you covered vacant landlord policy, you covered this, that, and the other thing, and it all seemed to be the same rate, no matter kind of what that policy was as far as the hazard side goes. Is that also a correct assessment?
Yeah, absolutely. Yep. And it's as this space grows, and it's growing so quickly too, we I guess we found that out about 5 years ago or so and dipped our toe into it and realized, oh, wow, there's a real need out there for policies and what we like to say is on-demand policies, because we can turn these quotes around that we've written to match up with all the lenders out there. So it's a policy that if it's a rental property, we can cover it and we can get a quote quickly. If it's a rehab that needs builder's risk, then we can do that. So yeah, and we can do that in all 50 states.
Fantastic. Laura, can you back up your screen one more so people can see your contact information again? So I had Tim ask for your email.
Okay.
Perfect. Awesome. And I absolutely love that you're so educational. Both Kris and Laura were fantastic to work with. I've personally have used them for my master policy. If anybody has any questions, you can feel free to reach out to them directly. You can unmute yourself now if you have a question you want to kind of run past them in front of the group, or put something in the chat. I'm just going to check the chat real quick for any messages. I did get one sent to me for forced place insurance. And it sounds like, I think you answered this. For forced place insurance, is there an annual renewal cost to me as a lender?
Gotcha. Yeah, no.
No. Okay.
No costs. Nope.
And then do you cover lenders in US territories as well? Was another question.
Like Puerto Rico?
I'm assuming if you want to unmute yourself. Yes,
Yeah,
Puerto Rico.
I would have to look. I think Puerto Rico may be a no, but I can check the master policy and get back to you.
Okay. So check in with them, Tim.
Okay. Thanks for the answer.
You're welcome. Yeah.
We tried, we had a lender from Puerto Rico and we had to turn them down. I think the answer is no, but I'm going to double check that.
Just to be on the safe side.
Yeah, I will double check.
Okay. Yeah. And it might be different for this type of business too. Laura, was that a depository or traditional lender that had a property they were trying to force place on, or?
So there's two things that I remember happening. One was a depository lender located in Puerto Rico. The other was a lender actually in Chicago that had a property in Puerto Rico. And I remember there was an issue because number one, our system couldn't handle the Puerto Rican address.
Okay.
And then it came up, oh, well, we can't write a policy outside the continental US, but I know we can write Hawaii. So I will ask the question and check.
And then Kris, this might be a question for you. Is there anything to keep in mind specifically for California?
The rates are lower in California.
The rates are, yeah.
Like the dollar that Kris was talking about in California is like 52 cents for the, I mean, the dollar in the rest of the country is like 52 cents in California.
Yep.
So we're okay there. And then I see another question.
Right now, though, in California, Laura, before you jump in there, flood. So make sure you get both of the hazard and the flood master policy, because there were a lot of moratoriums in California for flood insurance over the past month because of all the flooding out there. So
yeah, I was gonna say heavy record snowfall. It's got to melt eventually.
That's right. Yes,
Yep.
exactly. So there's earthquake coverage that's available out there too that you can get on rehab projects or rental projects. But you know, flood obviously is becoming more and more of an issue. But other than that, no, California, surprisingly, like Laura said, the rates are really good.
Yeah, it's
Forced master policies.
one thing on the flood that I will say, full transparency on the flood versus the hazard, there is a $50 policy fee on the flood that does not exist on hazard. That is charged on every flood policy where there is earned premium. So if we force place a flood policy that is then canceled, flat canceled, the 50 is refunded. But if we earn 1 day of premium, we earn 1 day plus the $50 policy fee plus some taxes. So that's that. There's a question here. What if we're in second position, but the first position has not acted to force place? That's a very interesting question because, you know, typically in our market, we tell lenders all the time, you don't need to worry if you're in second position. I mean, a lot of lenders in second position blanket their seconds because in theory, the first people are tracking it and there's coverage out there and you're okay. But you absolutely can force place from the second position to cover yourself in the event. Yes.
Is that, to get a little bit more in depth there, is that in a home equity position? Or is that just a normal second mortgage position? I'm assuming.
And more than likely is probably going to be some sort of fixed annualized interest only loan, just happens to be in the second lien position. It might be behind something like a hard money lender. It might be behind some sort of permanent financing that they have. And then they're using that second lien to tap into equity because they don't want to refinance out their 2 or 3%, 30-year fixed, but they're going to access some equity to the property. So the second lien more than likely is going to be something that's a fixed annualized simple interest rate just in the second lien.
Yeah, that's an interesting question. There may be some other different coverages that you might want to look at that would be better than a forced place policy if that's how you're doing all of the lending that you're doing. Because if you're always in second position, I mean, correct me if I'm wrong, Laura, but a blanket policy would probably be nice because then you're not going to have to worry about the insurance at all.
Correct. The only problem would be the size of the portfolio to get someone to write a blanket on the seconds.
Yeah, that's true.
And when you do that blanketing seconds, there typically is a minimum premium amount that could range to $300, $400, $500 a month.
Okay. Yeah.
On seconds. I mean, I have a lender that has 10,000 seconds. They have a blanket.
Yeah.
But they have 10,000 of them.
A little bit different than our particular group.
Yeah.
Exactly. But
Yeah.
I mean, you can look at it.
Awesome. Well, that was a great question, Siva.
Yeah, absolutely.
All right. If you have anything else, feel free to reach out to either Laura or Kris. Both have been a wonderful wealth of information for me. It says, what is the smallest number of properties? I'm assuming what's the smallest number of properties you can insure is probably Siva's question.
Yes, Alex, can I speak?
Sure, go for it.
Yeah, I'm a really small time lender. No more, I only have 10 loans. Am I a suitable candidate for you?
Where are your 10 loans?
In California.
Oh, probably. If you said Florida, I would say no. They're all 10 in Florida. We could look at it.
Yeah. Yeah, absolutely.
That's awesome. I'm feeling the Florida love here today.
Yeah, it's Florida's really, really tough right now. I mean, one of our carriers has now come out and said the maximum in Florida is 10% of the portfolio. And if you have 12%, forget it.
Yeah.
Whereas we used to write banks in Florida all the time. So definitely changing the market.
I believe it. I believe it. Well, thank you, Kris and Laura, for coming out and educating us on some forced place insurance and giving us a little behind the scenes on considerations us as a lender should have in place when we're doing these loans and making sure that our assets are actually covered the way we think they're covered. So otherwise, feel free to reach out to Laura and Kris to the information that's on the screen, and look forward to having you back in the future sometime.
Wonderful. Thank you, Alex.
Thanks so much for having us.
Thanks, everybody.
Thank you very much, Laura and Kris.
Thank you.
You're welcome. Thank you.